This is a story of an Alberta business owner who did everything his accountant told him to do for 20 years, and it cost him about half of everything that his money earned. Okay, so he's now moving over $200,000 a year of that same money into a place where it grows without getting taxed every year. Same money, completely different outcome. All right, so here's the situation. Business owner in Alberta runs multiple companies, been at it for a long time, and his accountant gave him advice that honestly wasn't wrong, which was leave the profit in the corporation and don't pull extra dividends out. Don't hand it to the CRA at your personal tax rate. So he did that year after year, and it worked. He built up well over $2 million in retained earnings, but nobody told him that what happens to that money once it's just sitting there, because $2 million doesn't just sit still. It earns something: interest, dividends, capital gains, whatever it's invested in. And in Alberta, the passive income that surplus generates gets taxed at close to 50% every single year. That's the adjusted aggregate investment income rules. And on top of that, once your passive income crosses $50,000, it starts grinding away at your small business deduction, which means that your active business income now starts from getting taxed at 12% to 27%. So he's getting hit from both sides. His retained earnings are being taxed at 50%, and they're making his operating income more expensive as well. So that's why he finally picked up the phone. Nobody sold him on anything. He just got sick of watching almost half of every dollar his money was earning in investments disappear to the CRA every year. And what he said to the advisor stuck with me. He said, I don't mind paying my tax. I just don't see the value in the taxes I'm being forced to support. So the advisor reframed the whole conversation for him. He wasn't asking, how do I pay less tax this year? He was asking, where can this money live instead? Because a pool of capital you can access that isn't taxed every year is always going to beat the same pool of capital that is. Same money, just different address and very different results. So the advisor that was assigned to him was Mike from Alberta as well. So the advisor built two things for him. First, a corporate owned permanent life insurance policy funded right up to the maximum the CRA's exempt test allows. So that means that discretionary premiums well above the minimum required, because the entire point is to use as much of that tax exempt room as possible. And growth inside that contract is not taxed year to year. And the cash value doesn't count toward that passive income threshold that was grinding away at his small business deduction. So he's solving both problems at once. And second, they set the funding at about a tenth of his total surplus per year over 10 years. So just over 200K annually. He didn't move everything at once, and he didn't want to. So he wanted to maintain liquidity in the business while gradually shifting retained earnings from a 50% tax environment to a 0% tax environment. And here's what matters to a business owner. All right. The money is still his. He can borrow against the cash value whenever he wants. He can take withdrawals if he needs to. If he has a slow year, he can adjust what he's putting in as well. So he's not locked into anything he cannot flex around. And when he eventually passes away, the death benefit goes to his beneficiaries through the capital dividend account, which means that most of it lands tax-free to his succession. So the money that was getting taxed at 50% every year is now growing tax exempt, accessible when he needs it, and transferred to his family without tax when he's gone. All right. So now I want to be clear about something. This only worked for this specific business owner because he had over $2 million that his companies generally did not need to operate. That was just sitting there in his corp. So this was true surplus. If your retained earnings are working capital that you need to run your business, buy inventory, make payroll, there's nothing here to fund. So this strategy is for money that's sitting there doing nothing except generating a bigger tax bill for you. All right. So if you're a Canadian business owner with surplus piling up your corp, and nobody has ever told you that what's the actual cost every year in passive income and in taxes, well, that's a conversation worth having, because every year that you wait is another year you're paying close to 50% on money that doesn't have to be taxed at all. So links is below in the description if you want to have a conversation.